Hi, this is Steve Chinelli reporting from San Francisco. Welcome to the recent edition of Crowd Caucus, where we bring together some of the thought leaders and movers and shakers in the crowd space, hoping to deliver to the audience some new perspective. Before going into it, I'd like to introduce our special guest today, Brian Korn. Brian's a senior attorney and corporate securities attorney with a law firm of Pepper Hamilton. He is a renowned expert in the area of the Jobs Act, crowdfunding. He's been profiled on various media sources, Fox Business Television, Bloomberg, NPR, has been published or quoted in Forbes, CNBC, MSNBC, the New York Law Journal, just all over the place. Very, very reputable, very perspicacious gentleman who's got a lot of things to say. Hello, Brian.
Hi, Steve. Happy to be here. Thanks for having me.
Great, great. Before we launch into it, let's go over to our partner, Sydney Armani, who has the recent news in the crowdfunding space. Sydney.
Thanks, Steve. Thanks, Brian. Happy to join you guys. I'm going to get a couple of report from CrowdFunding, and this segment is brought to you by Carlton Group, Carlton Real Estate Group. I have a segment of the CrowdFunding. They're one of the sponsors of this program. And we'll start with the Representative Patrick McHenry is wanted to introduce a new bill for the next month. A new bill is going to be around the crowdfunding, so they're not going to wait for the Title III, basically. So they're going to introduce another bill. And another is that crowdfunding is starting getting more attention on a couple of companies. Actually, they're getting to the games, mostly IRA. And tech accelerators use equity crowdfunding to go public. So this is the company is using the tech cities come from Tech City News and mostly from Capital Group, Development Capital Group, OTCBB. So they're trying to get some sort of kind of the secondary market on that, and a couple of the other, mostly hair-raising experience in the startups that it's happened. It's Rooster Teeth, raised about $1 million in a matter of 3 days, and that's that. They're making films, so that's another validation over there. So this all is happening. This week news is, but it's all good news. That what we see is still real estate is getting a lot of attention, and there are a couple of reports that the Hong Kong Nest equity crowdfunding platform, they are starting for the startup, and that's it. But so it's overall it's getting there. It's getting harder. The name crowdfunding out there. So all the news that we have is going to be in the crowdfundbeat.com.
Great, thank you, Sydney. Well, let's jump into a conversation with Brian here. Brian, you recently wrote a piece that was published in Forbes about the trouble with crowdfunding. Can you share a little insights in terms of, everybody says this is a panacea, this is a great way for capital formation. Certainly there's some trepidation on behalf of the SEC and FINRA regarding investor safety, and we can certainly go into that in a moment. But share with us some of your insights on what's the problem, what's the trouble with crowdfunding.
Sure. Well, I wrote that piece responding primarily to Title III of the Jobs Act, which, as people know, is the ability to crowdfund to the members of the general public without regard to whether or not they are accredited investors. As you know, there's Title II, which a large portion of the securities crowdfund world operates under, which allows now for advertised private placements to accredited investors only. Congress, in the Jobs Act, enacted Title III, which allows for crowdfunding to members of the general public. But it did so with quite a few strings attached, and that's why I wrote the piece on crowdfunding. For example, a company using Title III to the public can only raise $1 million of equity or debt in any 12-month period. Investors will be restricted based on their income and levels of net worth. If you make less than $100,000 and have less than $100,000 of net worth, then you will be restricted to the maximum amount of $2,000 across a 12-month period. There's SEC reporting requirements. There's SEC filing requirements. You have to produce a disclosure document. And you also have to engage a funding portal, which requires you to hire an intermediary. So all of these aspects are part of the first part of what I think the trouble with crowdfunding. The other trouble with crowdfunding is that you're taking the world of startups, which are a risky asset class to begin with for investors, assuming that companies that are able to raise venture money and other types of conventional fundraising don't engage in crowdfunding. You're left with an even narrower, riskier slice of the startup world. And with Title III, you're taking these investments, which are extremely volatile, very liquid, and very risky, and you're laying them at the doorstep of the mom and pop investors. And so it is probably the opposite of what Congress and the SEC would like in terms of taking the riskiest assets and having them go to the investors that can most afford the risk. Here you have the inverse of that proposition.
But Brian, you're an expert in both the 33 and the 34 Act. You've seen, certainly you've articulated concerns, at least from the SEC perspective, on crowdfunding. It's my contention that a couple things, that the definition of accredited investor, which I know the SEC has been looking to change to bump upwards in terms of net worth and income levels, is somewhat archaic and antiquated. And I say that largely because the purpose of Reg D, or in its earlier framework, I think it was Rule 146 back in the 33 Act, then it came into 1974, and then 1982 it really defined the income levels and the net worth levels, which they tweaked a little bit. The intent there was to enable smaller companies to form capital, to raise capital without going through the harangues and the level of disclosure requirements in terms of registered offering. And if in fact they placed the money with well-to-do investors, they could not only absorb the losses, but they, and this is part of the 33 Act, and they had their own means by which to understand the risks and then do their own disclosure activities.
Right.
Run this, now in the world of, the internet, availability of information broadly, the fact that the 33 and the 34 Act were concocted in an analog environment, maybe you can comment on the accredited investor concept overall. And my last little point, because I'm waxing on here, is while the SEC is trying to protect the ma and pa investors from investing in high risk illiquid securities, they basically are silent in companies raising money on the junior exchanges, the OTC market, the QB, the QX, that anybody can throw any bit of money in their life savings into companies that may not be anything more than a shell, and subject to not only investment risk, but trading risk. Maybe you could comment on what I view as an inconsistency.
Yeah, no, absolutely. First off, so accredited investor, you're right, is an old definition. There are a number of entities that are accredited investors, including banks, insurance companies, broker-dealers, and businesses that have at least $5 million of net worth. Most people focus on the natural person test for an accredited investor, which is an individual that has $200,000 of income, $300 for a married couple, or $1 million of net worth. And thanks to Dodd-Frank, the net worth test now excludes the value of your primary residence. That's the most significant change that we've seen in the last couple of years to the definition. And the SEC has left the definition largely untouched, However, in the latest round of rule proposals, they've asked for comments on whether the accredited investor definition should be modified to either index to the consumer price index or inflation somehow, or otherwise be adjusted. Most of the people who have written in have still said that the accredited investor test, although crafted a long time ago, is a known quantity. It's into the mainstream lexicon, so not only lawyers and accountants, but most investors and many investors are aware of the standard. And to index it would create a situation where you'd have an odd number of income or net worth every 3 to 4 years whenever they make the adjustment. So instead of 200,000 of income, now you might have to make 211,500 of income, and it would step up in a way where many people wouldn't know the rule, similar to postage stamps and other types of items that get indexed up. I don't think that accredited is a standard that delineates intelligence. Many people mistake it for that. I think that the SEC and Congress, frankly, just need to be in a position to draw the line somewhere on who can afford the risk of loss and who cannot for a transaction that's done without the benefits of SEC review and disclosure. You can always register a transaction with the SEC and go through that process and have full disclosure and sell to whomever you want. But in order to be exempt from that process, the accredited investor test was crafted. One thing that people forget also is that accredited investors include officers and directors of the issuer itself, regardless of whether they have income or net worth. So something to keep in mind is, as you go forward, you're able to buy in your own company if you're an officer director, even if you don't meet those requirements. With respect to the offline, or what we call unlisted securities markets, this has really been an issue that I think is going to get a lot more attention in the next year or so. The listed exchanges, what we call the SROs, NASDAQ and New York Stock Exchange, have very robust listing requirements, both for new listings and continued listings. There are a class of companies that are still traded publicly, but are listed in these off-market exchanges, which are largely unregulated. You don't need GAAP financials. You don't need to file periodic reports if you qualify for that. And you really are taking your money in your own hands at that point by buying some of the stocks that are on the exchange. Some are delisted for valid reasons. They may have failed the minimum price rule, which on most exchanges is $1, and are looking to do a reverse split, which will bring them back into compliance and hopefully get them back listed on an exchange. But there are a number of stocks that trade that are largely untracked and unmonitored, and it's similar to buying any type of item off the street versus going into a regular store that has some semblance of regulation. Now, it is not true that every company that's on the OTC bulletin board does not have to file public reports. If you have had a registration statement or have done an offering in the past 2 years, then you are required to file public reports in the same manner that you would if you were listed. But there are obviously several companies that are not able to do that and have fallen off of that scale, and for those reasons have chosen, mostly for financial reasons, not to continue their periodic reporting. So you have to look carefully in that world and determine which of the companies that are still reporting and which are the ones that are not, and understand the risk that if you're investing in a company that's listed or quoted on one of these exchanges but does not file reports, that you're going to have less than transparent information versus a company that is.
But don't you see that as a antithetical, completely inconsistent in terms of what the SEC is trying to prescribe for Title III and protecting, again, the non-accredited investors, and the fact that the basic tenet of this whole accredited investor was really twofold. Number one, the ability to absorb loss, But then secondarily, which again is a basic premise, is the accredited have the means by which to do their own due diligence, do their own disclosure, obtain their own disclosures, really capture the information that would be incumbent within some sort of a registration statement. The fact that we're living in a world of social media and broad-based access to information, doesn't it make more logical sense for the SEC to say, yes, it's caveat emptor, let buyer beware, as long as you companies disclose in a certain manner selected information to provide the decision making for investors, regardless of their financial capacity, the ability to make an informed decision.
Yeah, no, I agree with that. I agree with all that. There are two sides of the SEC at work here. The origination side, which is the Division of Corporation Finance, does the rulemaking on new issues,
Sure.
and they basically look at the world as what can you do with respect to raising? Do you have to register, or do you have to, or are you eligible for an exemption? The OTC world is the secondary world. What do we do with these securities once they're issued? Presumably they were issued lawfully at the time, but they're still kicking around, and it's an open marketplace for people who want liquidity and want to sell. You certainly will have less information about an OTC company than you will about a company like IBM or any listed security that's required to comply with the rules. Now, sometimes stocks that are listed are still volatile because rules come out or new developments come out in the business that cause the trading volumes and the trading prices to shift. But I agree with your premise that why do we let just anybody buy the smaller stocks or the penny stocks that aren't listed on the exchanges? The SEC has done a lot of work around penny stock reform, and just because something isn't listed doesn't mean that people have carte blanche to commit fraud. And I know that they are looking for cases where people are engaging in fraudulent activities with respect to trading in securities, and they'll go after folks even if they're not trading in listed stocks.
Let's sort of move this upscale a little bit. Let's move away from the Title III into the Title IVs and Vs. When the whole Reg A plus area. What's your view of moving the limit from 5 to 50 under Reg A to the Reg A plus? What do you think that's going to do for the market?
It's going to be interesting. I think that there's still going to be deals that are more suited for the Title III world or the Title II world. Reg A plus is the small offering exemption. It allows companies to raise up to $5 million without registration with the SEC, and the shares that are issued in that process are unrestricted shares versus the crowdfund Title III shares, which are restricted for a year, and the Title II shares, which are also restricted. So you have a process here where, through the Jobs Act, they've now created a two-tiered approach to Reg A. The first is Tier 1, which is the old Reg A. You can raise up to $5 million without regard to who you sell to, so you can sell to members of the general public. And the second is Tier 2, where you can raise up to $50 million, and if you sell to qualified investors or accredited investors, then you're going to have something that Reg A has been lacking this whole time, which is what we call state law preemption or blue sky law preemption. That is the process by which the federal government can tell all of the 51 state and D.C. securities regulators that they have exclusive jurisdiction over these transactions and that no filing or compliance or registration is required with respect to the states. So, for example, in a registered offering, a Section 5 offering, you file with the SEC, you're going to have a listed security, you're going to have state law preemption. You don't have to go state to state and register the deal in all 50 states. Reg A, before the Jobs Act, did not have preemption, and you had to go to every single state, which was a large part of why Reg A went unused for so many years. Reg A Plus says you can raise up to $50 million. You will get preemption if you only sell to accredited investors, so it shows a lot of promise. The one thing people don't realize about Reg A is that it's a slower process. You still have to create a disclosure document, which is called an offering circular. You still have to file the thing with the SEC and wait for SEC comments to come back, and really go through a review process that's not dissimilar to an IPO. So the speed to market that a private placement has, or a Title II transaction has, will still win in terms of efficiency over a Reg A transaction. But you may prefer Reg A in the end by being able to have a security that's not restricted versus one that is. Now, the question you might ask is, what good is having an unrestricted security when there's no market to trade it on? And that's going to be a big issue that comes up, is how will the exchanges deal with Reg A transactions? Because right now, they're only permitted to list registered securities offerings, so the IPOs. But will there be a market that develops for the Reg A transactions, perhaps on the alternative trading systems like second market?
Well, actually, that's a good point. It sort of reverts back to, we sort of started in the Title III world, moved up to the Reg A world. But let's revert back. One of the things you brought up is the liquidity. The fact that you might have a registered security, but if in fact you don't have a place to trade, the illiquidity aspect becomes an issue. What do you see in the world of crowdfunding? Maybe you can talk about the liquidity or illiquidity. Certainly the Jobs Act was one that wanted to get more capital into small business. It's not necessarily just for the high growth technology companies that have aspirations of going public, the next Google, the next Facebook, and so on. It was really intended for small America or small town businesses and so on to raise a different level of capital. But as you know, many of those types of companies probably aren't the ones that will go public, or for that matter, be acquired by a larger organization. What do you do about the liquidity aspect of the liquidity concerns in the crowdfunding space?
Well, it's a problem. It's not something that's easily solved. You're going to have an influx of companies that are issuing shares through crowdfunding transactions, and no one's going to be able to do anything with them with respect to a secondary market. It's going to really be a buy and hold security, and we're dealing with an equity security which doesn't have a maturity date. You may want a sooner exit than you'll be able to get through crowdfunding. Title III crowdfunding rule proposal states that there will be a 1-year holding period for all shares that are issued through Title III. Title II doesn't have an express holding period, although there are only a handful of ways to sell securities that are issued in a private placement
144
in the U.S. Yeah, Rule 144A, which you can sell after you've held it for a year for a non-public company, or 6 months for a public company if you haven't been an affiliate in the last 30 days.
Mm-hmm.
And then what we call 4.1.5 transactions, which are institution resales. But in terms of really being able to sell, unless you have a buyer, there isn't going to be a market. And so what I predict is that the more popular and the more heavily subscribed crowdfunding campaigns will find that there's a need for a secondary market, and you'll see that crop up through either second market or through other types of alternative trading platforms. Now, to run an alternative trading system, you do have to be a broker-dealer, so somebody will have to form a broker-dealer or use an existing broker-dealer to implement that process. Obviously, someone like Second Market that already is a broker-dealer and an ATS can issue crowdfunding shares, but they're not interested in doing that unless there's going to be sufficient volume. So, go ahead.
Yeah, to that point, it's interesting. I saw late last year that the guys over at Second Market shifted their business model. They were on fire relative to pre-IPO shares of Facebook,
Right.
some of these other guys, and they just did a bang-up job. Really created a nice little niche for themselves. But then Facebook, of course, went public. Twitter went public. Some of these other companies said, well, maybe we don't want to have our private shares or our unregistered shares traded so freely in the private markets. And we saw that, again, Barry and the guys at Second Market shifted their model. What does that bode negatively for secondary liquidity?
Well, yeah, absolutely. I mean, whenever you have a shortage of liquidity providers, you're going to have a cash crunch. A lot of people are funding. So they're just backing up for a second.
Sure.
In the crowdfunding world, we're basically living in sort of a tale of two worlds. One is the rewards plane, which is the Kickstarter, Indiegogo, Rocket Hubs. Those are platforms that are not offering securities or any kind of investment. They're actually just offering a reward or a perk in exchange for your investment. It might be a product, it might be a hat, it might be a thank you email or something like that. The securities crowdfunding world is going to need to have some sort of outlet for transactions that are priced. And I predict the majority of transactions will not have a second market listing. There are requirements with respect to listing on these exchanges. They require that you're a real business, that you have an audited financial statements, that you're, you have compliance procedures in place. So, it's not a situation like Craigslist where you can go online and sell anything you want. It's more of a system like StubHub where approved and sanctioned events are posted, and if you don't own a security of a company that other people are going to be interested in buying, you may have a problem with liquidity, and you may have to end up selling it back to the company or selling it to your friend or your neighbor. So the where the market's going to develop will be interesting. The Oculus transaction was very interesting.
Sure.
Because that reflected a profound misunderstanding that a lot of people had in the crowdfunding world, including a lot of professionals, in that Oculus was, in their second year, they did a Kickstarter campaign for $2 million, and then a year later were sold to Facebook for $2 billion. Many of the people in the Kickstarter campaign mistakenly thought they had bought an investment in Oculus and were wondering what their exit was going to be like, and they're inflating sort of their shares on a pro rata basis based on what Facebook was purchasing the company for, and they were told, actually, you're a rewards crowdfunder, you were part of the Kickstarter campaign, but you don't actually have any investment or any skin in the game from the investment side. And so just correcting the misunderstanding and the misperception that people have that the rewards platforms are actually engaging in investments is a big start, I think.
It wasn't. I think I read a figure that $1,000 on the Kickstarter campaign, if in fact it was an equity security, it would have translated into $250,000
Oh yeah. Yeah. Well, in fairness, what happened was on the Kickstarter campaign, the primary perk was a set of virtual reality goggles.
Yeah.
So the company came back and said, well, we shipped you your goggles. Our obligations end at that point. We thank you for helping build the business, improving the concept for us. And there's backlash in the rewards world for companies that become successful, and I don't really understand that. I think that the notion that you should only bring your tired and poor and huddled masses to Kickstarter, I think is not the right way to think about this. I think you need to think about it as a true starting point for businesses, and I advise clients that if they have the inclination and have a product that would make a successful Kickstarter campaign or rewards campaign, that they should absolutely take it, presuming that the cost of their rewards tiers will not outstrip the price people are paying, less the fee, to fund the rewards. So you know, it is free money in a sense, and I think that by doing a rewards campaign, you're not precluding yourself from doing an equity transaction either in the crowdfunding world in Reg A or being acquired in an M&A event, as we've seen.
So last question, because I think our time's running thin here. Brian, turn the pages forward. What does crowdfunding look like domestically, internationally, regulatory-wise, legislatively 1 year from now?
Very interesting question. Great question. I think that my prediction is we're basically where we are now. The noise around Jobs Act 2.0, which is the bill that Mr. Armani referred to earlier, and the notion that the Title III rules would be revamped in a way where, for example, instead of $1 million, you could raise $5 million, and instead of needing an audit at $500,000, you would need it at $3 million. That, regardless of whether it actually has legs in Congress, is going to give the SEC a lot of pause in that they're not going to want to waste their resources putting out rules in July or August that are going to be completely overhauled by Congress a month or two later. So the existence of a second law, a second bill in the works that could significantly alter the rules, I think is delaying the process. I think the Reg A Plus is on a faster track. I think you're going to see Reg A Plus formalized maybe this summer, and you'll have companies starting their Reg A Plus offerings this fall. It's an interesting process. Again, you have to write a disclosure document. You have to go through the SEC comment process. So, if you are in the world of raising $50 million, I don't think too many 30, 40, $50 million Reg A Plus offerings, because you almost have to do as much work as you would to do a listed IPO. So if you're raising $50 million, there are NASDAQ IPOs that have raised less than that this year, far less. So I think that Reg A Plus will be a reality, though, and people will start to take advantage of that. And I think Title II is going to continue to proliferate into many different dimensions, into the world of real estate, into the world of other types of industries. You're going to see peer-to-peer lending grow dramatically on the debt side, and you're going to see all sorts of diversification of uses of proceeds.
Yeah, Brian. Last question, but in line with this this stream of consciousness. Certainly, social media has had a big effect on, and just communication patterns in general through the internet. It seems as though many countries outside of the United States, whether it's in the EU, Canada, Latin America, Asia, whatever, have been a lot more forthcoming in advancing crowdfunding. One of the observations, and Sydney and I actually had a delightful conversation a week or so ago with Jonathan Metfin over at OurCrowd, and OurCrowd is based in Israel, but they have an international approach to things. I believe in Kickstarter the same way, but that's not a securities-based deal. We don't talk anything in this legislation, or do we? You're more insightful than I about the globalization of what we're doing in the U.S. In terms of changing things like FERPTA and elements of the Patriot Act and so on and so forth, because this is truly, crowdfunding is truly a global phenomenon, and it's access to information, access to investor disclosures, the aggregation of small amounts of money from all disparate spots, which suggests that it's a global phenomenon. We're not addressing that at all. Why?
It's interesting. So crowdfunding was designed to plug a very specific type of leak in the boat, and it is not to say that international investors cannot engage in crowdfunding, But with respect to fundraising to the public on the issuer side without registration, the SEC has said no to international companies doing crowdfunding transactions in the U.S. So that's part of the Jobs Act, and that's fairly well hardwired, as they said no to current public companies doing any type of Title III crowdfunding. Where you have a lot of interest is on the investor side. You'll have investors from Canada, from European Union, from China, who want to invest in U.S. campaigns, and what I advise clients on primarily is how to make your website compliant so that you can attract and sell to an international investing community. Jobs Act Title II and Title III and Reg A Plus are really domestic-focused exemptions, but that's not to say that there also isn't Reg S, which is the international-focused exemption, and your ability to raise money offshore. And there are plenty of transactions, both in the online world and in the traditional finance world, which involve both a U.S. exempt transaction and an overseas Reg S transaction. Mm-hmm. The key thing you have to remember, though, is that if you're selling securities, for example, to a citizen of Canada, that you want to make your site compliant to not only comply with Reg S, but also comply with any local restrictions that person may have. And that may get to be very complicated. If they live in Vancouver and you're selling to a citizen there, yes, you can make your site Reg S compliant and have an overseas tranche similar to what you have with respect to your domestic tranche, but you also want to make sure that you're not having the investor violate any Canadian or any provincial securities laws with respect to their investment in you. And so having the site effectively blue-skied for the world-skied, is something that we're going to see more and more of as interest starts to grow. But certainly you also have platforms developing in each of these countries that is servicing the local community.
Well, great. Brian, thank you so much for your insights and your perspective. I really appreciate you taking time out from your schedule. You got both screens going and listening to Elizabeth Warren on the backside. I saw that. But anyway,
market's down 15 points.
Okay. Well, anyway, Brian, thank you so much. And Sydney, let's hand it back to you, okay?
Thank you very much for the audience, and guys, have a wonderful day. See you next time, another audience, actually, with another show with the Crowd Caucus.